Hey, good morning once again, options traders. Well, a message that I have in a lot of my videos is that to succeed with options and strategies, it helps to understand your pricing relationships because that's really what strategies are all about. They are all about taking advantage of relative pricing discrepancies in the market. Because if you don't have a relative pricing discrepancy, there's not really a good reason for taking the trade. But see, a lot of times new traders don't see it that way. They go, oh, I heard about this strategy, as if it makes all the money in the world for no risk, and they start putting on strategies. But if you don't understand the reasons behind the strategies, you're going to fall into a lot of traps and misperceptions. And this is a really good one. So we're going to talk about what's the difference between a call and put time spread. And you're going to find that there's a lot of different messages in this video. For those of you who trade time spreads, you'll find out how they should be valued, the difference between them. For those of you who trade synthetics, we'll also gain some insights into how synthetics are priced. And for everybody else, you'll find out that there are just two ways of looking at the same thing. So let's start with a little definition of a time spread, and I do have other videos in this forum on a time spread for those of you who may not be familiar. But as a quick refresher, it's also called a calendar spread or a horizontal spread. And that's because when you're looking at your broker's platform with the months across the top, you'll find that these quotes sit horizontally or between the different expiration months. So that's a time spread, but the breakdown is that you will buy a longer dated call and you will sell a shorter dated call with the same strikes. And of course, we could do it with puts as well. So for example, maybe you buy a March $100 call and you sell the January $100 call. So it's actually considered a long time spread if you own the longer dated option. And of course, it'd be a short time spread in the reverse. But the thing that we want to figure out is what's the cost? Well, let's break it down very simple first. Let's not get into the technicals and make it look very difficult and mathematically complex. Let's say that the interest rate is 5% and that you lend somebody $100 and this person pays you back or you receive $100 after 1 year. Is there a cost? And on one hand, some people would say, well, no, you spent 100, you received 100, and you've got your money back, and so therefore there was no cost. But obviously that's not true, because if the interest rate in this example is 5%, you pulled that money out of your savings account or your checking account, gave it to this person, and you're not earning interest. So it's really what's called an opportunity cost. It's money that you missed out on by taking this money out of your account. It's not really money that you physically spent. But we could still say that there is a cost of $5. So in the markets, of course, there are no freebies. And in this example, if you were to spend 100 and collect 100, even though there may not be any risk in the sense of the principal, there's still a cost, and the market's going to account for that. So let's look at an example, and let's say that you buy the January $100 call, and then you sell the January $100 put. Now, for those of you who understand synthetics will recognize this as a synthetic long stock position, and that just means it's behaving just like long shares of stock, long call, short put. And then on the flip side, let's say that you sell the April 100 call and buy the April $100 put. This is a synthetic short stock position or a synthetic short position. So if you bought the synthetic long and you sold the synthetic short, effectively what you've done is you've purchased shares of stock for 100. Why? Because mathematically that's what it is. And then you've sold them for 100 out here in April. So it's exactly what we just saw. You are spending 100 in January or letting $100 cash go out of your account, but then in April, you're getting the $100 back. So it's minus 100 plus 100, and therefore you really didn't face any risk of principal because notice that the strikes are the same. You spent 100, collected 100, and that was guaranteed to happen. But that doesn't mean there's no cost. There was a cost because you were out the money during this period. Now this little strategy here of being synthetic long matched with synthetic short has a catchy little name in the market. It's a strategy called a jelly roll, and I do have another video in our forum here on jelly rolls. But there's a lot of different reasons why traders might use jelly rolls. And for this video, I'm not going to go into them instead of just looking at it from an option pricing standpoint. But what should the value of this jelly roll be? Well, let's say that interest rates are 4% or about 1% per quarter. And that's what we're looking at here is the difference. There's a 3-month difference between these two. And so 1% per quarter is $100 right there times 1% or $1. So this jelly roll should actually cost $1. Or we could also say that there is a $1 difference between the April synthetic and the January synthetic. So notice that we're looking at these vertically. We've got January matched with January, call and put. And over here we've got April matched with April, call and put. But I could also look at these horizontally. I could just look at the calls combined, and I could say that if we bought the April 100 call and sold the January 100 call, then we have a calendar spread. If I do it with the puts, we've got a long calendar spread here. So notice that if I'm looking at it vertically, we are looking at this in terms of synthetics, but if we look at it horizontally, we're looking at it in terms of calendar spreads. So they're really just two different ways of saying the same thing. So to see some examples, let's go over to an Excel spreadsheet. Okay, so now we're into the Excel spreadsheet, and it looks complicated, so let's step through what these numbers are. Right here up at the top are the basic data that we'll be using for the entire sheet. So we have a 100 call and a 100 put, 30 days to expiration, 60, 90, and 120. And of course, these are the prices according to a pricing model of these calls and puts. Now I used 2% for the interest rate, and I know that's not anywhere close to what we're seeing in the markets these days, but if you don't put in a fairly large interest rate, it becomes hard to see the differences. So what is the cost of carry for a month? Well, over here we have 2%, and right here we're saying 2% divided by 12. That would be the monthly rate. And so if we take that times $100, it's about 16 cents, almost 17 cents per month. So keep that in mind, and then we'll take a look at some of these positions. Let's start with the synthetic long and short. The synthetic long is just the long call short put. So we're just buying this call and selling this one. It's going to cost us 16 cents. For 60 days, we are going to buy this call, sell that put, and it's going to cost us about 33 cents, and so on across each of the columns. Now, the synthetic short, if you think about it, is exactly the same as the long. It's just the trader on the opposite side of the trade. So notice that these numbers here on the synthetic longs are exactly the same as for the synthetic short. We just have the signs reversed. So this is minus 16 cents. It's going to cost us 16 cents. If we sold the spread or did a synthetic short, we would receive 16 cents. So that's looking at the quotes vertically. Notice we have the call on top, put. We're taking call minus put in each of these. So that's a look at the synthetic long and synthetic short. But what if we look at them horizontally? Let's look at the time spreads. If I buy the 120/90, now this notation means that you are long the first number and short the second. So you're long the 120 call and short the 90. That means you would be paying about $4.89 and receiving $4.20. It's going to cost you 69 cents. If we did that same time spread with the puts, you would spend $4.23, collect $3.70. Going to cost you about 52, almost 53 cents. And if we look at the difference between these two, it's 16 cents. And that was the question that we posed at the very beginning of the presentation. What is the difference between a call and put time spread? And there's your answer. It's the cost of carry. And so you can see about 16 cents, very close to what we got for just the cost of carry on the exercise price. Now there's a reason that they're not coming out exact here, because this was just the cost of carry on the $100. We'd have to actually get a little bit more technical. Not really important for our purposes here, but you can see it's roughly the cost of carry. So if it's costing you about 16.5 cents for 1 month, should cost double that, or about 33 cents for 2 months. And there it is. If you buy the 120 expiration, 120 days to expiration, and sell the 60, that's a 60-day difference between them. And so that's going to cost 33 cents. So now let's see if the synthetic long and synthetic shorts line up with our time spreads. So watch this. Let's grab a blank cell, and let's say that we buy the synthetic long here, but we close it out with the 90-day synthetic short. We're therefore buying it for 100 and selling it for 100. What's the cost? Right there, 16.46 cents, exactly the same as the time spread. What if we did it for the following month? If we bought the 120 synthetic long and we closed it out with the 60-day. So this would be a 2-month synthetic, would cost us about 33 cents, exactly the same as the time spread. So again, you might be thinking, well, this looks like it's just too good to be true. It's like it's magic. Well, it's not. It's just two different ways of looking at the same thing. Notice that with the synthetics, we're taking call minus put and then looking at the differences. With the time spreads, we're taking call minus call and then put minus put and then looking at the differences. So it does look like they are two very different strategies, and they are identical. They're just different ways of looking at the same thing. So again, back to the beginning of the presentation, yes, we did want to figure out what is the difference between two time spreads, between the call and the put time spread. And we now know that it's the cost of carry on the exercise price. But probably a bigger message is to realize that if a lot of strategies seem complicated to you, and you're going, why are there so many different strategies and why do they seem so complex? They're probably not all that complicated. In this case, it's just a simple matter of understanding that if you lend $100 and get it back in a month, that the cost of carry for that 1 month period is the cost of that transaction. And if you understand that, you've now got the cost of the jelly roll, you've got the cost of the time spreads, and you've got the cost of synthetics all under one roof. So this is why it's so important to not go out and memorize strategies, but instead to understand your options theory and pricing principles. Because if you understand that, strategies now make a lot more sense. Because you won't be putting a strategy on for the sake of a strategy, you'll be putting it on because of a pricing discrepancy. And that's the real reason for taking any option strategy. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.